Good evening, everyone. So you're welcome to another class on corporate reporting. Today, we are going to be starting a new topic, financial instrument. Financial instrument is what we're going to look at today. We finished up with employee benefits last week. And I can remember clearly that we ended it up with some assignments that I said you should solve some questions. I hope you have looked at those questions. They're very important you look at them. Extremely important. Okay, I think we should start our class straight away. So today we have another important topic. Every topic that we are looking at here every topic is the same level of importance. So tonight we're going to be looking at another exciting topic called financial instruments. So before I go into which standard we're going to use to narrow down into what financial instrument is, so broadly speaking, or generally speaking, when we talk about financial instruments, there are majorly two things. They can either be debt instruments or they can be equity instruments. So basically, financial instruments are debt and equity instruments. And when we say a debt instrument, so an entity is said to have a debt instrument when it borrows money from another entity. So it has a debt. So if an entity A borrows money, it will have done that by either issuing a loan note or issuing a debenture or issuing a bond or issuing a commercial paper. Or you could have even issued an overdraft, something like that. So the borrower, we call the borrower an issuer, while the lender is an investor. And these are common things that happen everywhere. It happens almost on a daily basis. You see companies. I mean, there was a recent one that Dangote issued. He issued commercial paper. It simply means Dangote wants to borrow money. Dangote would have a debt. Now, those that are investing, those that are giving him money, they are an investor. That is a debt instrument. So, of course, there will be an issuer and there has to be an investor. If those parties are not present, we cannot even have a debt instrument. Somebody must be giving money, somebody must be collecting. And that's why we have a debt instrument. But you see, an equity instrument, so say an entity has an equity instrument. When it collects money from another party, and that other party automatically becomes a shareholder in his company. When you collect money from another person, and that money you collected from that person makes that person becomes a part owner, or whom we call a shareholder in your company, then what you have done is you have issued an equity instrument. While in the case of debt, what we issue are instruments like loan notes, debentures, bonds, and the likes. In equity, the instruments we issue are majorly ordinary shares or preference shares. Those are the instruments they issue. So today, what we want to learn basically, when we say financial instrument, all we are talking about is debt and equity instrument. And today we want to learn how to account for that, both from the side of the issuer, the person that is collecting money, and from the side of the investor, the person that is giving money. And also for the case of an entity that collects money, and collecting that money makes the person giving the money become a shareholder. We want to look at how to account for that as well today, both from the side of the entity collecting money, giving out its shares, and the party who is an investor who has now become a shareholder. So your first challenge tonight that you really must understand very well tonight is, firstly, identifying that we have issued a debt. Like at what point that, okay, what we have issued is a debt. And identifying who is the issuer, who is the investor. And also your ability to distinguish that from when we have issued an equity or ordinary shares. That is the major part of what I want to teach you today. As soon as you're able to get that, then we will go and sleep. Then we'll continue next week. That is my aim for today. Now, in teaching you this, I'll be using two major standards. One is IS 32 that talks about financial instruments presentation. Is this standard that will teach us how do you classify a financial instrument into liability or debt and equity. So this is my focus for tonight. Your ability to see a financial instrument and be able to say, okay, this is a debt instrument. Oh, this is an equity instrument. This is what we want to learn tonight. Next week, I'll be looking at compound financial instruments. And I've taught you a compound instrument before in this class. Can any one of you remind me, in which standard did we mention compound instrument? Oh, I've forgotten. I'm teaching CR. Nobody will talk in this class. The standard we did that was IFRS 2 on share-based payment, where there is a choice of settlement. If you remember, I told you that in that scenario, the entity has a compound instrument because we are promising to our employees that, okay, you have a choice of either taking cash or taking shares, because we don't know what the employee will settle for. In accounting for it, we'll consider element of the two, because we don't know what the employee will take, whether it's going to go for the cash that will ultimately make us have a debt instrument, or you go for the shares that will make us have an equity settled share-based payment? We don't know. So we will consider element of the two. Go and watch the video. So now today again, not today, next week, we are also going to be looking at compound instrument. Yeah. Today, I'll also get to some part of IFRS 9 that deals with financial instrument recognition and measurement. In this standard, we'll look at recognition of financial instruments, the recognition of financial instruments, measurements, then impairments. It also looks at aging, but I'm not teaching you aging here. And we're not going to look at financial instrument disclosures, but the standard that exists. So let's start with IS 32. Like I've mentioned, IS 32 will teach us how do you present, how do you classify a financial instrument either as liability or equity? And we'll also look at possibility of offsetting a financial asset and a financial liability. But basically, the focus for tonight is this first objective, how to classify an instrument either as a debt or an equity. So you need to understand the scope of IAS 32 very clearly, because if you had been able to relate one or two together, you should see that what my colleague is teaching you in group account is basically intercorporate investments where one entity is investing in the shares of another entity, and its holding in that other entity makes the entity becomes a parent because now he has control because of his voting right, giving him control or giving him significant influence. Today also, some part of what we are learning is investment, is intercorporate investments, where we invest in the shares of another entity. But here now, we are looking at a scenario where the investment is just a simple investment, where your holding in that other entity is less than 20%. And that is what IAS 32 and IFRS 9 deals with. And that is what we call financial asset. By the time you invest in another entity and your holding goes above 20%, then that is not just a financial asset. That becomes an associate investment. And should your holding goes above 50%, that even goes beyond associate investment and becomes a subsidiary investment. So tonight, the equity interest we are looking at tonight is not the one that results in subsidiary or associate or joint venture investment, because accounting for subsidiary investment is dealt with in IFRS 10. Accounting for associate investment is dealt with in IAS 28. Accounting for joint venture investment is dealt with in IFRS 11. Our focus for tonight is how to account for liabilities and equity instruments of less than 20%. Equity instrument of less than 20%. How do you account for such investment? That is what IAS 32 and IFRS 9 looks at. IAS 32 defined financial instruments as any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. A contract. Financial instrument is a contract. And when we say a contract is basically an agreement between the two parties. It does not necessarily have to be in writing, but it must have clear economic and legal consequences. That is what makes it a contract, in the sense that we have an understanding, and if you do not do your own part, there will be economic consequences. There will be legal consequences. That is a contract. For there to be a financial instrument, there has to be a contract. And this contract gives rise to financial asset of one entity, meaning one party must have a financial asset. And another party will now have either a financial liability or equity. That goes to show that before we can have a financial instrument, there has to be two parties. One must have a financial asset, and you can guess the one that will have a financial asset. That will be the investor. That will be the investor, because that is the person that has an asset. He is the one investing. And another party will now have either a financial liability or equity instrument. So at every point in time, which is what I said we want to learn today, is that other party, whom I call the issuer. You need to know that based on the instrument he is issuing, is it a financial liability he has, or is it an equity instrument that he has? You need to be able to identify that. And that's also very straightforward. I've mentioned it today. That was the first thing I mentioned. That if the financial instrument in question is a debt, where we would have issued either a loan note, a debenture, a commercial paper, a bond, you see, that issuer has a financial liability. He has a financial liability because he has issued a debt instrument. Debt instrument gives rise to financial liability. But where the issuer issues ordinary share capital or preference share capital, then that issuer has an equity instrument. So what I've just mentioned is so important and so easy, and it can become confusing to some students that do not get it. And I hope you have all gotten it. Now, I will then go ahead and explain further. What is a financial asset? What is a financial liability? And what is an equity instrument? Again, IS 32 said that a financial asset is any asset that is cash. An equity instrument of another entity, or a contractual right to receive cash or another financial asset from another entity, or to exchange financial asset or financial liability with another entity under conditions that are potentially favorable to the entity. Financial asset is any asset that is cash. What is cash? Cash is cash. It has no other definition. Cash is cash. So when you have cash, be it the money you have in your hand, or the money you have in your bank, or your highly short-term investment, that is cash, you have a financial asset. Cash is a financial asset. So as an accountant, when you want to classify cash in hand, bank, you want to know which classification of asset it belongs. It is a financial asset according to IS 32. Financial assets can also be an equity instrument of another entity. An equity instrument of another entity. Meaning that when you have an equity instrument of another entity, you have a financial asset. And how can you have equity instrument of another entity? It's by buying their shares. If you buy shares in Zenith Bank, if you buy shares in MTN, if you buy shares in Dangote, if you buy shares in Equity Professional Limited, you have a financial asset. Why? Because you have invested in the equity instrument of another entity. You have a financial asset. You are an investor. Financial asset is an equity instrument of another entity. Financial asset is also a contractual right to receive cash. Contractual right to receive cash. When you have right to receive cash, you have a financial asset. And primarily, what can give you right to receive cash? Number one, if you lend somebody money, if you give somebody money and the person is supposed to pay you back the principal and the interest, automatically that gives you contractual right to receive cash. Meaning at every point in time, when you have things like loan receivable, lease receivable, bond receivable, that is a contractual right to receive cash. Because the person must pay you interest and principal. They must. They cannot fail. That is a contractual right to receive cash. Note that that is why we separated when you invest in shares from contractual right to receive cash. They are different. Investing in shares, buying shares of Zenith, GT Bank, or any other company for that matter, does not give you right to receive cash. It doesn't. You are a part owner, quite all right, but you don't have right to receive cash. It's at their discretion that they pay dividend. So that's a separate financial asset on its own. Now we are saying that financial asset can also be an instrument that gives you right to receive cash. And basically that is when you lend somebody money or when you sell on credit and you have a trade receivable, or when you are the lessor and you gave your asset to another party and that party will be paying you periodically and it has to pay, you cannot fail. Or when you are the landlord, you have a property and you are a landlord, you have a contractual right to receive cash. You have a financial asset. Not only cash, it could be another financial asset. It could be another financial asset. Or if you have a right to exchange financial assets or financial liability with another entity under conditions that are favorable to you. exchange financial assets. It's possible to exchange. It's possible. This is not so common in this part of the world. That's why you will not find it commonly in your exam. But it's possible. I mean, we can exchange loans. We can exchange. I can have borrowed somebody or lent somebody money, and you have also lent another person money. We can exchange. That, okay, why me? Why you want to go and pursue my own borrower? You want me to go and pursue your own borrower? It happens. It's not just common here. But it's possible to exchange financial asset or financial liability under conditions that are potentially favorable. You see, the one I'm concerned about is understanding that this contractual right to receive cash. That's the basic one. So, for my explanation here, you need to be able to know perfectly well that financial asset is three things. It could be cash, it could be investment in the shares, in the ordinary shares of another entity, and it could be investment in debt, because that's what will give you contractual right to receive cash, or when you sell on credit. And some examples of financial assets are trade receivables, lease receivables, equity instrument of another entity, cash or check, loan receivable, bond receivable. Now, financial liability is any liability that is a contractual obligation to deliver cash. Very important. Contractual obligation to deliver cash. This is a very strong sentence here, and it applies at every point in time. If you are very good at transferring knowledge, you should then be able to understand that that cash settled that we learned in IFRS 2, where we say that the entity would give cash based on the value of their shares. You should then know that that liability that we have there, that we used to recognize there, is a financial liability, because the entity has a contractual obligation to deliver cash. Not necessarily only cash, it could be another financial asset. It could be another financial asset. If he has an obligation, that can also fall in as a financial liability. And it can also be an obligation to exchange financial asset or financial liability with another entity under conditions that are unfavorable. Under conditions that are unfavorable. So examples of financial liabilities are trade payables, notes payable, loans payable, bonds payable, or lease liability. Those are examples of financial liability. Now, note that when you have assets like PPEs, inventories, leased assets, intangible assets, all of these physical assets, They are not financial assets. They are not. Because all of them does not give right to receive cash. It's just like you have a machinery that you are using to produce your products. Even though the machinery produces the product you sell, but does that mean the machinery gives you right to cash? No. What all the machinery is doing for you is that it's giving you an opportunity to generate cash. It's different from when you have right to cash. They are different. Financial assets gives you right to receive cash, meaning you don't have to work. Don't just do anything, just sit down, money will flow in. That is a financial asset. So physical asset like inventory, what will be tempted to think that when you have inventory or items that you are holding for sale, that is a right to receive cash. No, it's not a right to receive cash, because if you don't sell those inventory, you will not get money. You need to make efforts, serious effort to sell inventory. And some can even remain unsold. When we say right to receive cash, when we say something is a financial asset, it means you don't have to work. I mean, it's just like you lend somebody money or you sold on credit. What do you have to do again? No, you have right to cash. You have done the work shares in Zenith MTN. You don't have to work. Or you have cash in the bank. You don't have to work. The rich are rich because they have financial assets. Furthermore, items like prepaid expenses, like you paid rent in advance, prepayments, it has to be very clear that it is not a financial asset, because such payments in advance will give you right to service, will give you right to goods. It's like you paid for goods in advance. And yes, they will deliver your goods, or you paid the rent in advance. And yes, you will use the service, or most of you have paid your lecture fees, like paying lecture fees in advance. And yes, we'll teach you. Those are not financial assets. Financial assets, what you're expecting is cash. At least that part of financial assets. On the flip side, looking at liability, financial liability, we cannot categorize items like deferred revenue or income received in advance or most warranty obligations. They are not financial liability, because they do not give rise to an obligation to deliver cash. When you receive money in advance, you have received money in advance for services you have not offered, then offer the service. You are not giving cash, you're going to offer a service. The obligation you have is to deliver service. It is when your obligation is to deliver cash, then you have a financial liability. Finally, liability and assets that are not contractual, such as tax payable, they are not financial liability or financial asset. They are not. Even though when you look at tax payable very closely, you would think that that is an obligation to deliver cash. Yes, it is an obligation to deliver cash, but it is not contractual. A financial liability is a contractual obligation to deliver cash. Contractual obligation to deliver cash. So tax payable are never financial liability. And the final one is equity instrument. An equity instrument is any contract that evidences residual interest in the asset of an entity after deducting all its liabilities. Equity instrument is a contract that evidences residual interest. Residual interest as in the owners of business who get returns last, who get considerations last, that you need to have paid every other stakeholders in the entity. It's only the residual that they get. Those are equity. That's what we call equity instruments. And equity instruments could be ordinary shares, it could be preference shares. Those are equity, and even your reserves, residual interest in the asset. In the asset. So they are the one that gets the remaining, the residual in our asset after deducting all liabilities. And for my explanation so far, examples of financial instrument contracts could be credit sales, not cash sales, so not cash sales, credit sales. Credit sales is a financial instrument contract because it meets that definition of financial instrument I gave you. That I said that financial instrument is a contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. Credit sales meet that definition because there is always a contract when you sell on credit. You'll have given an invoice. There must have been an agreement. And it gives rise to financial asset of one entity, who is the entity that has a trade receivable, the seller. And it gives rise to financial liability, who is the buyer, which we call trade payables. Because the seller has a right to receive cash, the buyer has an obligation to deliver cash. You will see that from the angle of the buyer now, we said it's a financial liability here. It's not equity because we need to choose. This one is a financial liability because in this case, the buyer has an obligation to deliver cash. And the instrument here is credit sales. So there is a financial instrument contract. Another one is bank savings or any form of bank deposits. When you deposit money in the bank or any valuable in the bank, that's a financial instrument contract because it gives rise to financial assets to the depositor, to the customer, because you have a right to receive cash from the bank. And the bank has a financial liability, customer deposits, which is an obligation to deliver cash at any point in time. When a customer comes knocking, the bank must deliver cash. They have an obligation to deliver cash. So that transaction, bank savings, is a financial instrument contract because it meets that definition completely. Another one is loan transaction, whether from the bank or from your friend or from family or from whoever, any source. Loan transaction is a financial instrument contract because it gives rise to financial asset to the lender, to the giver, to the investor. He has a financial asset, that's loan receivable, and financial liability to the borrower, loan payable. So the two sides are complete. Loan transaction is a financial instrument contract. Lease contract, it also gives rise to financial asset to the lessor that has a lease receivable. He has an investment in the lease. And a financial liability to the lessee because he has an obligation to deliver cash. The same thing with treasury bills. When you buy treasury bills or bonds, either from the government or from corporate entity, there is a financial asset who is to the buyer or to the investor, and there is a financial liability to the issuer, usually the government, as the case may be. Or ordinary share transaction. Most of us want to start a company. You must issue shares when you want to start a company. In this part of the world, it's very difficult to get capital. In the West, in the developed world, they have better access to capital there. So you see people issuing shares. You see investors coming in through this type of transaction. It's a very, very good transaction. So when you have ordinary share transaction, it is a financial instrument contract because the buyer, the investor, has a financial asset. Even though he doesn't have a contractual right to receive cash, but remember that financial asset is an equity instrument of another entity. I hope you remember that part of that definition I gave you. That financial asset is an equity instrument of another entity. So when you buy shares in another company, you have a financial asset. You are the investor. And the issuer in this case does not have a financial liability, but now he has an equity instrument. Equity instrument is issuing shares. Is issuing shares. Okay, I think that's the end of the first part of this class. So we'll be solving questions now before I move to the next part. So we have questions. I have like 2 questions here. 2 very good questions for us to solve. So before I go to the questions, do you have any clarifications? Do you need anywhere where you want me to recap that you really do not understand, something like that? Please feel free to communicate. I'm here to help you. Any questions from anyone? Anybody? Okay, good. So let's start solving our questions. It states here that the following relates to Networks PLC for the year ended 31st December 2021. So they give us all these transactions. And I said required, determine whether the item above are financial assets or financial liabilities, and also state whether a financial instrument exists as at 31st December 2021. Okay, it said determine whether the items above are financial assets or financial liabilities, and they want us to state whether a financial instrument contract exists. Okay. So the first one, they say that net worth owns cash of 5,000. I know that cash is a financial asset. So yes, there is a financial asset, because financial assets, if you remember, I told you is cash. Financial asset is cash. Is any asset that is cash. However, in this case, we don't have any other party that has either a financial liability or equity. So yes, this cash is a financial asset to net worth, but since we don't have any other party that has either a financial liability or equity, that means it is not a financial instrument contract. There is no financial instrument contract here. For there to be a financial instrument contract, there has to be two parties. So the answer to this one is that net worth has a financial asset, which is cash, and it is not a financial instrument contract. We don't have a financial instrument here because there is no other party. The second one says that net worth owns a demand deposit of 1 million with First Bank. Net worth owns a demand deposit. And you know what a demand deposit is? Demand deposit is when you keep 1 million with a bank and you say that, keep it for me for 1 month. Keep it for me for 2 months. I don't want to touch it. That is a demand deposit. It's like a fixed deposit. So net worth owns that with First Bank. Automatically, net worth has a financial asset, because that's a contractual right to receive cash. Because it will pay him interest. He will collect his principal at maturity. That is a financial asset. While the bank has an obligation to deliver cash, which goes to show that the bank has a financial liability. Now, because we have a party that has a financial asset, and we have another party that has a financial liability, that means this transaction is a financial instrument contract. Number 3, net worth statement of financial position includes 2.5 million shares of Google of Google Incorporated. So in the statement of financial position of net worth, he invested 2.5 million in the shares of Google. And remember that financial assets is any asset that is equity instrument of another entity. When you buy shares in another company, in this case now, net worth bought shares in Google. That is a financial asset. That is a financial asset. Google, who is the issuer of those shares, has an equity instrument. Google has an equity instrument. So, because now we have a party that has a financial asset, and we have another party that has an equity instrument, that means there is a financial instrument contract here. There's a financial instrument contract here. The next one says net worth statement of financial position includes inventory of 56,000. In this case, inventory is not a financial asset. Like I've told you earlier, Inventory only generates or gives you opportunity to generate cash. It doesn't give right to receive cash. An inventory is not cash. Inventory is not equity instrument of another entity. Inventory does not meet the definition of a financial asset. Even though it is an asset, it is a current asset, but we cannot classify it as a financial asset. Inventory is inventory, according to IS2. So it will be classified as an inventory. So in this case, net worth does not have a financial asset. And we don't have any other party. So it is not a financial instrument contract. The next one is net worth sold goods amounting to 55,000 to lie on credit. So this is sales on credit. Net worth will have a trade receivables, which will give net worth the right to receive cash, which is a financial asset. While lie, who is the buyer, will have a financial liability, that is a trade payables, which is a contractual obligation to deliver cash. So now, because we have financial assets that net worth has, financial liability that lie has, so the two sides are complete. There are two parties. So we have a financial instrument contract. Says on December 2021, net worth received an advance payment of 250,000 from one of his customers, Muri, to deliver goods. Okay, so this one we received net worth, we received payment, we received 250. It's just like you guys that you have paid for your lectures in advance. Now you are now receiving the service gradually. So it's a similar scenario here. Net worth received 250. And the obligation he has is to deliver goods. Again, net worth in this case does not have a financial liability. In fact, this is what IFRS 15 calls contract liability, which is not a financial liability. Why? Because net worth only has an obligation to deliver goods to Muri. He has an obligation to deliver goods to Muri. So for that reason, it is not a financial liability. It's just a contract liability. And Muri itself does not have a financial asset because it's not receiving cash. What it will receive is goods. So we don't have any financial instrument contract here at all. It's not a financial asset, it's not a financial liability like that. The next one says net worth statement of financial position includes a current tax liability of 5,000, as well as a deferred tax liability of 6,500. A current tax liability, yes, is an obligation to deliver tax, to pay cash to the government. But like I mentioned earlier, it is not contractual. I don't have any contract with the government. It's just my civil responsibility. It is not a contract. So current tax liability is not a financial liability. While deferred tax liability, this one is not even an obligation to deliver cash. It's just an accrual for tax. It's just, we have just trying to account for the tax implication of transactions that will happen in the future. The impact of the future tax impact of a transaction now. What is its tax impact today? That's a deferred tax. It's not an obligation to deliver any cash. So we don't have a financial liability here, and no party has a financial asset. So there is no financial instrument contract here. And the last one is net worth purchased a Bitcoin of 5,500. Bitcoin is not a financial asset. Bitcoin does not give you a right to receive cash. So when you buy Bitcoin, it does not right to receive cash. Even though, yes, you can sell it. You can sell it, but it doesn't mean you have rights. You would sit down and not do anything and be collecting money. No, nobody owes you money. Yes, it can be growing in value, no problem. So it's not a financial asset. So there is no financial instrument contract here. In fact, the right way to classify Bitcoin would be an intangible asset. But for those companies that are holding it to sell, to resell, because some companies sell Bitcoin, you can go and buy from them. Those ones, they will classify those Bitcoin as inventory. So we don't have a financial asset here. And that is the end of this question. Any questions? Any questions? Hi, Priscilla.
All right. So can you go over why inventory is not a financial asset?
Okay.
Thank you.
Yeah. No, thank you. I think you're a new student. People who have been teaching in this class, they never say anything. We don't even know whether they understand what we are saying or not. They will not just say anything. So thank you. So inventory, it is not a financial asset because it does not meet the definition of financial asset. Inventory is not cash. Inventory does not give right to receive cash. So when you have inventory, yes, it's something you want to sell. That's if you are able to even sell it. So inventory gives opportunity to generate cash. So inventory cannot be classified as a financial asset. It can only be classified as inventory according to IES 2. It does not meet the definition of financial asset according to IES 32 that we have here. It is not cash. It is not shares in another company. It is not right to receive cash. So it does not meet those definitions. And that is why inventory is not a financial asset. Because it only creates an opportunity to generate cash. That's if you're able to sell, then you will get cash. If you don't sell, you won't get cash. So that is not financial asset. Financial asset requires no effort at all. Money will just be flowing in. When you have something like that, that is a financial asset. Even when you're sleeping, you do nothing. People are working for you. You have invested in the past. This money is now flowing in. That is a financial asset. Did I answer your question, Priscilla?
Yes, you did. Thank you, sir.
All right. Okay. Because you people don't talk in this class,
Sir,
I would.
please, Sorry, can you go to F, item number F? I
Okay,
was thinking it's a financial liability since it's like a prepayment to the organization.
okay. So let me go over that again. So now, this is not, yes, it is, it's not even a prepayment as far as net worth is concerned. Net worth actually collected the money in advance. So prepayment will have been from the standpoint of Mori, who was the one that paid in advance. So now from the standpoint of net worth received the payment in advance. He received the payment in advance. Now, this is not, is a liability as far as net worth is concerned. I will teach you that in IFRS 15, that it is a contract liability. When you receive money and you have not done the work, that's a liability in accounting. You will learn that when we get to IFRS 15. So, but this liability in question is not a financial liability. You cannot classify it as a financial liability because the obligation net worth has is to deliver those goods. It's clear here. To deliver goods. For you to have a financial liability, the obligation must be to deliver cash, not to deliver goods. Not to deliver goods. And that is why this contract liability here to net worth, this money you received in advance, which you call a contract liability, is not a financial liability. It is a contract liability. It's another type of liability entirely, but definitely not a financial liability because the obligation net worth has is to deliver goods, not cash. Did I answer your question, Bidemi?
Yes, please. Thank you, sir.
Okay. Okay, so what I would do is you don't have this question in your this particular one in your handout. I'm going to send it to you right away. I would want you to use that as your assignment. I mean, it's going to be very nice for you if you can solve it. If you solve it, I would give you the solution. It will be very nice if you are able to solve it. It will enlighten, to give you some eye openers. It's not a very straightforward question, and that's why I want you to try it out. Okay, so I've shared that question with you. I've shared it with you. So please look at it. So it's just within what I've taught you, but it's just for you to apply those knowledge. They gave you 3 transactions, and they want you to write a memo discussing how each transaction should be treated in the financial statements in accordance with IAS 32, 15 marks. So that means each of them is 5 marks each. I've shared it with you. Oh, okay. If you're not on the group, please reach out to me. So how are you able to get this link to this class? I'm surprised. If you're not on the group, how are you in this class? You should not be in this class. Okay, I'm not show you the solution. This is the solution here. Okay. Now, let's look at another part. Recognition and the recognition of financial assets. or financial instrument. So let's start with recognition. And by now you should be familiar with recognition, which is recording or including an item into the financial statement. So a company recognizes either a financial asset or a financial liability into the financial statement when the company becomes a party to the contractual provision of the instrument. So you can recognize a financial asset or a financial liability in your books when you become a party to that contract. And look at this place. An entity becomes a party to the contract at the date of the agreement or at the date of the commitment, either at the agreement date or the commitment date. So it's just like you sold goods to somebody, not even sold goods, you received an order from a customer. Are you going to immediately recognize sales or trade receivables? No. It's only when you have commitment or when you have an agreement. It's not the guy said, I want to buy. I want to buy does not commit him. Do you people have an agreement that the guy cannot go back, that he has to buy? So at least one party must have actually performed. Either the guy has paid or you have transferred goods. It is at that point that you can say, okay, yeah, now I have a trade receivables. Oh, now I have a trade payables. Is either there has to be an agreement or there have to be a commitment. So financial asset or financial liability is recognized when the entities becomes a party to the contract. When they become a party to the contract, then you can then recognize whether a financial asset or a financial liability when they become a party to the contract. There's no complexity in that definition. Very straightforward. There's no complexity at all. The next one is the recognition of a financial asset. When we say the recognition, we are talking about removal of a previously recognized financial asset from an entity's statement of financial position. That's derecognition. And an entity should derecognize a financial asset when these two occur. So for your exams, you need to know these two derecognition criteria. And number one, when the contractual right to the cash flow from the financial asset expire. When the contractual rights to the cash flows from the financial asset expire. Remember that a financial asset is a contractual right to receive cash. So when that your right to receive cash has expired, then remove it from your books. Remove it. As soon as that right to receive cash is no longer in existence, remove it, derecognize it. Contractual right to receive cash. So the contractual right to the cash flow from the financial asset expire, or the entity transfers substantially all the risk and reward of ownership of the financial asset to another party. When the entity transfers substantially all the risk and rewards of ownership of the financial asset to another entity, derecognize it because you have transferred the risk and the reward. And when we say you have transferred the risk and reward, it can either be probably maybe you have sold the financial asset. You have sold it. Whatever it is, that if maybe the financial asset you have is receivables, you sold it to another party, or maybe the financial asset you have is shares in another company. You then sold the shares. Remove it from your books. As soon as you have transferred the risk and the reward, you have to recognize. Or you sold the financial asset, but you have an option to repurchase at fair value. It's as good as sold, even though you have a repurchase right, but you are repurchasing it at fair value. If you are repurchasing it at a fixed price, then it becomes a problem. Then that one is not transfer of risk and reward. But if there's an agreement to repurchase at fair value, that's fine. It's as good as you have sold. That repurchase is a fresh transaction. But if you are repurchasing at fixed price, at a predetermined price, then that one is biased. That repurchase is not is controlled by you. It means you still have some reward. It means you still have control over the transaction when you are the one dictating the repurchase price. You see, before you can derecognize a financial asset, these two must occur. These two must have occurred. You must establish that they exist. Your right to cash has expired. You have transferred substantially the risk and the reward. Let's solve some questions. It says that XYZ Bank holds a portfolio of trade receivables amounting to 5 million. To improve its liquidity, the bank enters into an agreement with ABC investors selling the receivable for 4.8 million under the terms of the agreement. Number one, XYZ Bank transfers the legal right to receive cash from the receivable to ABC investors. However, XYZ Bank provides a guarantee to ABC investors that if any of the receivable becomes uncollectible, XYZ Bank will compensate ABC investors for the loss. The bank retains the right to purchase specific receivables under certain conditions required. Based on IFRS 9 financial instruments, should XYZ Bank derecognize the trade receivable from its financial statements? Justify your answer by evaluating whether the risk and reward of ownership have been transferred. So now, you see, to determine whether XYZ Bank should derecognize these trade receivables as required by this question, you need to ensure that these two exist. These two must exist. If only one of it exists and the second does not, you cannot derecognize it though. You will continue to recognize it. So let's analyze this question and get our answer from it. So this bank has a trade receivables of 5 million. He sold it. He actually sold it to ABC for 4.8 million. But now the agreement is this. So the bank transfers the right to receive cash to ABC. Okay, so that one is clear. It meets this first condition, this first step. The right to receive cash has expired. So he has transferred the right to receive. So his own right to receive cash from that trade receivables has expired. He cannot receive cash anymore. So he has met the first condition. Now, not only that, he must meet the second condition too. Has he transferred the risk and reward of ownership of the financial asset, in this case of the trade receivable? Has he? Looking at the second agreement here, XYZ provides a guarantee to ABC investors that if any of the receivable becomes uncollectible, XYZ Bank will compensate ABC investors for the loss. I mean, as you can see, this guy is still undertaking some risk. Specifically, we call that type of risk a credit risk. He's giving a guarantee to ABC that if he is unable to collect the receivable, that is going to compensate ABC. That is a significant risk, a significant credit risk, which goes to show that he hasn't transferred the risk. He has not transferred the risk. He hasn't. He still has credit risk. Not only that, he can also repurchase under certain conditions. So we don't know what conditions anyways. I mean, they were not so specific. So repurchase doesn't, we cannot judge by repurchase alone that, okay, he hasn't transferred the risk. Yeah, since he can repurchase, we need to be, we don't have sufficient information to really speak on this, right? So I would just say, yeah, it's okay, he can repurchase. If it at fixed price, that's fine. But you see, the fact that he undertakes significant credit risk here goes to show that he has not transferred the risk and reward. So for that reason, XYZ Bank cannot derecognize this receivable. So that means he will still continue to recognize this 5 million in his books as receivable. But the funny thing is that he has collected money. He has already collected 4.8 million from ABC investor. Can anyone tell me how this 4.8 million will be accounted for? Anybody? How is he going to present this 4.8 million in his books that he has collected? He's a liability. It becomes a liability in his books. He will debit bank. He will credit liability. You can call it whatever name. You can call it refundable deposits. Becomes a liability. Becomes a liability to him. And that is what we are saying. Before you can derecognize a financial asset, these two must exist. If those two do not exist, you have to continue to recognize it in your books. Any questions? Any questions? Okay, let's look at one more question. Okay. So we have ABC Corporation, a large manufacturing company, holds a portfolio of long-term loan receivables amounting to 50 million. amounting to 50 million. To improve its liquidity position, ABC enters into a securitization transaction with SYZ special purpose entity structured as follows. Number one, transfer of loan receivables. ABC transferred the loan receivable to SYZ in exchange for immediate cash of 45 million. Risk retention. ABC retains 10% first loss position, meaning it absorbs 5 million of any credit losses on the portfolio. Servicing loans. ABC continue to service the loans on behalf of SYZ special purpose entity, collecting payments and handling delinquencies. For this service, ABC receives an annual servicing fee of 1% of the outstanding loan balance. Variable consideration. If the loan performs better than expected, that is, credit losses are lower than projected, ABC is entitled to performance-based fee equal to 20% of any excess collections over an agreed threshold. Legal transfer of ownership. The legal right to the loans are transferred to XYZ SPE, and creditors of ABC cannot reclaim these assets in the event of ABC's solvency required. Under IFRS 9, should ABC derecognize the loan receivables from its financial statement, provide a structured analysis using the recognition criteria, considering risk and reward transfer, control assessment, and potential ongoing investment. Okay. This is a more detailed question than the first one. So the question is asking us, should ABC derecognize the loan receivable? Should we derecognize it? Don't forget, before we can derecognize a financial asset, because loan receivable is a financial asset, it must meet two criteria. Number one, contractual right to the cash flow must have expired. Number two, the substantial risk and reward attributable to ownership of the financial assets must have been transferred. So let's see. Now, ABC Corporation has portfolio of loan receivables, and its total value is 50 million. Now, this guy needs money, so he securitized it. I mean, securitization could be as simple as he collects money and says that, okay, all this 50 million as collateral. He converted it to a security, he liquidated it, something like that. Let's see securitization as simple as that. So he did that securitization transaction with SYZ. So you see, the agreement, this securitization, these were the terms. Number one, he would transfer the loan receivables, meaning that this ABC, you would transfer the loan to SYZ in exchange for immediate cash of 45 million. So that means they take 45 million and walk away. We don't want to see you again. Now, risk retention. ABC retains 10% first loss position, meaning that 10% of 50 million, it will absorb it. In case of credit losses, you will absorb 10%. Meaning that if those receivables should default, you will suffer 10% of the default. You will suffer 10%. Servicing of the loans. So now, maybe they have a deal with ABC that, okay, you can collect payments and undo delinquencies. Any of these guys that does not want to pay, you can help us with them, probably because they feel it's familiar with them. I mean, that is the agreement. That, okay, you should still be collecting payments, and we're going to pay you a fee for that. I said, I'm going to pay him an annual fee of 1% of the outstanding balance for that service he's rendering. Variable consideration, that if the loan performs better than expected, that they will give him 20% of any excess collection. So any excess collection that he's able to do, he will get 20%. Whatever that excess collection is, what is important is getting a reward of 20%. He has transferred ownership, meaning that the loan receivable no longer is receivable. It now belongs to SYZ. He has transferred those loans to SYZ. So the creditors now of ABC cannot reclaim assets in the event of ABC's insolvency. So what is important here is that ABC has nothing to do with this receivable anymore. He has nothing to do. He has transferred ownership of that receivables to XYZ. Okay, now these are the scenarios now. So two things we are looking for. So we're going to analyze all this and we're going to get whether we will derecognize it or not. So don't forget the two derecognition criteria. Number one, transfer the contractual right to cash flows have expired. We have transferred substantial risk and reward. So number one, have we transferred right to receive cash? Yes, he has. He has transferred the loan receivable. He has gotten an immediate cash of 45 million. So that means his right to receive cash has expired. He can't receive any further money as far as his receivables is concerned. So his right to receive cash has expired. So that one is met. Number two, has he transferred the risk and reward attributable to ownership? Let's look at it. Here, they said he's going to suffer 10% first loss position. So in case of credit losses, he will suffer 10% of it. So is this significant? Yes, it is. So that means he's still retaining credit risk. And it's significant. 10% is significant. So he's still retaining risk. He's still working. So this one is really nothing. The fact that he can work for the company to help them relate with the receivables, collect, he can do all that. And they are paying him for that service. So this one will just be like a professional fee for him. It has nothing to do with risk or reward. He's rendering service. This is like a separate service that this ABC Corporation is rendering. It has nothing to do with this transaction. He's just rendering an additional service. So that 1% he gets, it's like an other income to him. It's like a professional fee for him, which he will recognize in his books. Now, we have variable consideration, where they say that okay, if this loan performs than expected, you're going to get 20% of any excess collection. Now, this is a reward. So meaning that not only that he hasn't transferred the risk, he has not even transferred the reward fully, because the reward is still there for him. He's getting 20% of any excess collection. You see, this one is very much different from this one that is rendering service. That, okay, I'm rendering service, I'm helping you collect, I'm helping you handle delinquencies, you're paying me 1%. That is different from this one. That if the loan performs better, not that he's doing anything, but it's just an agreement in the securitization agreement that if the loan performs better than expected, you get 20% of any excess. That means he hasn't transferred fully the reward as well. You see, on the basis of the analysis I've just made above, it goes to show that ABC Corporation hasn't transferred the risk and reward attributable to ownership of this financial asset, of this loan receivable. So it should not derecognize it. In fact, he will continue to recognize this 50 million in his books. He will continue to recognize it in his books. The 45 million he has collected is going to be a liability in his books, while the 1% he's going to collect will come in as other income. 1% he gets will come in as other income in his books. You see, this scenario I'm giving you is just for you to be able to relate with this, so that you won't just be looking at these things. This scenario brings it to life for you. Because this is exactly how ICAN will bring it in your exam. They would bring you scenario, and they would ask you to tell us whether he can recognize the financial assets from his books. Any questions? Any questions?
Yes, sir.
Okay.
That the risk retention part, you said the risk is significant. What if is insignificant? Can we let it go?
Yes, we can.
Okay.
We can let it go. I mean, your next question should then be, how do you measure insignificance, right?
Yes, sir.
Yeah, so the standard didn't state how we measure insignificance. So is based on your judgment now. Seriously. It's based on your judgment. So maybe anything less than 5% might be insignificant. So the standards didn't state. In this scenario, we just look at it and say 10% is significant, maybe 1% is insignificant. But I trust you, in ICAN exam, they will give you a clue of whether it's significant or not. You would be guided. Promise you that.
Thank you, sir.
Yeah. Finally, for today, the recognition of financial liabilities. How do we derecognize financial liability? Very simple. Financial liability is derecognized when it is extinguished. Don't forget that financial liability is a contractual obligation to deliver cash. That means that as soon as you have delivered the cash, remove it from your books. Or as soon as you have settled, remove it from your books. So there are a lot of ways in which we can deliver this cash. In some instances, you could be forgiven the obligation and say, don't pay again. Yeah, you have delivered cash. Do you recognize it from your books? So that's why the right word to use is extinguished. That's the right word to use. So you derecognize a financial liability when it is extinguished. That is, when the obligation is discharged, is cancelled, or expires. Is discharged, is cancelled, or expires. That's extinguished. Discharged, probably you have paid it, you've settled it. Cancelled, the guy said, okay, pay no more. Expired, the period has elapsed. You have met some conditions. Expires. That is extinguished. Remove it from your books. So we need to be able to establish when it has been extinguished and when it has not been extinguished. Now, you see, when it comes to the recognition of financial liability, is a very complex area. Is an extremely complex area, I have to tell you. But I can tell you the complexity is outside the scope of your ICAN syllabus. Maybe if some of you are interested in deep IFR, we can go deeper on the recognition of financial liability. But for your exam, you are just very good. You are home and dry with understanding the fact that as soon as the liability or the obligation has been extinguished, you recognize it. I mean, you could run away with that. However, I need you to note this, even though we have never seen it in an ICAN question, but I just need you to note it that, okay, something like this exists. Number one is that where a lender and a borrower, okay, it's possible to exchange financial liability. It's possible to exchange. So when there is an exchange of financial liability, it means that the original financial liability with you is like you extinguish it. It's like it's cancelled. So you recognize that. So that means you are now going to recognize the new one you are getting. So exchange of financial liability can result in the recognition. Also, substantial modification of the existing terms of the financial liability can also result in extinguishment. And when we say modification, it's like saying a change in probably the interest rates or a change in the duration of the loan or any other terms that significantly affect the loan in itself is a modification. But the key thing here is they say substantial modification. And that's what I have here. That when we say a modification is substantial, it means that because you look at the original loan, the interest, the principal, if for those of you that are doing SFM, probably they have taught you how to do discounting to present value. We're going to discount the interest and the principal to present value. You get a valuation using the original terms. Then using the updated or the revised or the modified terms, like the new interest rate, the new duration, you would also do the same thing. You will get the present value of the interest and the principal. You see, when the difference between the original value using the original terms and the modified value using the modified terms, if the difference between those values is like 10%, meaning that if the value on the original terms, if it's given, let's say, 50 million, and the value, the present value on the modified terms is given, let's say, 60 million. So there's a change in value. So we need to check this change in value. The change in value is 10 million in this case. It's 10 million. Now, by the time you put 10 over 50, by the time you do 10 over 50, would that give you up to 10%? That's less than 10%. So that means in this case, the modification is not substantial. It means the modification is not substantial. But if it is up to 10%, then the modification is substantial. But in this case, if you do 10 divided by 50, that's 20%. So it's substantial. That's 20%. It's substantial. So that's what we mean by substantial modification. So when there's substantial modification, you see, and the original financial liability under the original terms will be derecognized, while the new one, you would recognize it based on the new value. So that's that. I just needed to make a mention of that. I needed to state it. They might not really ask you something on that. So let me show you an ICAN past question on the recognition of financial liability. I can ask a question on that. Okay, there are some simple questions here. I should be able to, how do you classify or come to it? The recognition rules. So this one is in November 2020. It says, in order to expand its operation, Muzana assessed the agricultural loan credit program set up by government of Nigeria. In the year 2016, Muzana was granted a 5-year interest-free loan of 100 million. At the end of September 2019, Muzana has been able to set aside 100 million in a special trust to be used for no other purpose than to pay off the loan in full on its due date in 2020. The management of Muzana are currently preparing their year-end 2019 financial statement and have recognized the loan liability due to the fact that funds have been set aside in full to satisfy the loan payment in 2020 required. Advise the management of Muzana based on IFRS 9, the recognition rules, if the loan liability can be recognized in the year ended September 30, 2019. 2019 financial statement for 7 months. Okay, so I mean, the substance of this transaction is that Muzana took a loan, right? 5-year interest-free loan. And he's supposed to pay back in 5 years. But at the end of like the 3rd year, the guy had already set aside 100 million in a trust fund. And the purpose of this is to pay off the loan. Not that he paid the loan, but he set money aside to pay. So that as soon as the due date comes, he just pays. So what Muzana did, okay, was that since they believe they have set money aside, so they recognize the liability from the fact that, okay, maybe we have set money aside, then we can recognize it. Now they want you to advise them. So how do you get 7 marks? So the first is for you to state the principle, which is that before you can recognize a financial liability, the contractual right to cash flow must have expired, and you must have transferred substantial risk and reward. For a year now, is contractual rights, what am I saying? That's for financial asset. For financial liability, is that the obligation must have been extinguished. That is, it must have been transferred, must have been discharged, must have been cancelled or expired. Okay, so in this case now, has this loan liability been extinguished? Has it been cancelled? Has it expired? Has it been discharged? No, it hasn't. Yes, he has set money aside, but that does not mean an extinguishment. It does not mean that it has been discharged. So for that reason, he should continue to recognize this 100 million in his books as a financial liability because it hasn't met the recognition criteria. It has not been extinguished. Okay? So these are the type of question you might find in the exam. Okay, we cannot look at this one. I've not taught you measurement. Okay, so that's for the recognition of financial liability. Okay. So do we have any question up to now? Do we have any questions? All right. So I'm going to stop here tonight. So next week, we'll move to measurements. We'll do measurements, and we'll also do compound financial instruments. Then upper week, we will do impairment of financial assets and maybe fair value measurement, IFRS 13. These are very short standards. So now where I want to stop for today, I've actually achieved it. So just try to go through this video and also try to do the assignments that I gave you. It will help your understanding. If there are no questions, then I guess we're going to see you in the next class. Thank you very much. Have a good one.
Thank you, sir. Good
So
night.
much, sir. Good night.
Thank you, sir. Good night.